Good afternoon. This is Ken at Tortoise Capital with a review of the weekend trading report for January 28th, 2018. Market is in bullish volatile conditions. On an annual basis with weekly RSI 14, we're overbought at 92 out of 100. We've pulled back into high neutral on the 10-day using the 10-day NDX at 67 out of 100. In the market mosaic, price relative to the 200-day moving average remains green bullish at 13.69%. The slope of the 50 is still a very strong green bullish 0.99%. ADX is a remarkable 51.1 in terms of strength of trend to the upside. That's almost a spectacular reading. Hard to maintain it at that level. We will see that reinforced by the slope statistic and the and the 10-day NDX for channeling. Relative volatility is volatile at 0.74%. There was a time when that was still quiet, and so just recognize that relative volatility is relative and goes through regime changes as well, and what was once extraordinary is now just normal. It's really a measure of just how unvolatile the market has been over the last 3 months, to the point where a 0.74% reading is into the volatile area now. So the risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. That reading is at 0.909, so we're into risk off. Take that score, look at the last 5,000 trading days, find the average and standard deviation to compute the risk Z. That comes in at a standard deviation score of minus 1.14, meaning that compared to the last 5,000 days, this reading of volatility is relatively sharp and risky, and we're more than one standard deviation below the long-term average. You see the 90-day histogram of that indicator right here. So this has been a period of larger ranges, sharper pullbacks in who had been the previous relative strength leaders. So will this rising volatility risk index here has been good for swing trading? This has been favorable to short-term intraday profit taking, and has been a good time to be respecting your profit preservation stops. When it rolls over at a distance more than one standard deviation below the long-term average, if it starts to march back up, that will be a sign of a regime change in volatility and will be favorable for swing trading. Next week we'll be looking at the rebalancing of the blended monthly. You see the leaders for this month, and these are the leaders in the clubhouse based on Friday's closing prices. The Dow 30 continues just to be amazing. Theoretical exposure in ETF2 remains at 100%. Here's some BMR portfolio. So we can take a quick look at sector performance and index performance. The Dow continues to dominate. There was a big move up this week in the globals, Latin America, emerging markets, Asia less Japan, and Australia, all turning in good performances. In the ETF 32, China, Brazil, and Latin America again leading the way. In the Dow 30, you can see here this was that pullback that I was talking about before. The relative strength leaders, all these that are green in the longer term, experienced some pullbacks or underperformance in this week. So that's either a turnaround where they're going to move back towards the middle of the pack, or this is buying quality on sale. I'll be certainly looking at Intel for a remarkable story, and United Health and Visa both look to be interesting, as do Travelers and 3M and Pfizer. Pfizer was a remarkable intraday trader on Friday. Apple now underperforming in every measured dimension and getting worse, and below his 4-month moving average. Sector Spiders expands the U.S. business sectors. To take a look at what we got there, energy gave it up this week. It's been dominating, but was underperforming this week, as was transportation and home builders. But strength in the healthcare equipment, biotech. ETF Max, same lens. Now we're looking at over 500 ETFs, and you can see the winners and losers. Again, I like to look among the relative strength winners. I like to see the dramatic outperformers and underperformers, because it's my belief that from those extreme conditions come extreme results. And if you look at the top 15, all but one of them were either extremely excellent or extremely bad. So you get these relative strength leaders have a lot more energy in both directions, so they become excellent for shorter term trading. Here's the market health check. The blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines give us price levels that were once resistance and are now support, and it would act as price targets on the way down based on where they broke through previously. Price has been in an uninterrupted channel up for 30 days, with just one little pause that reflected in the flattening of that 30 period regression line slope just a little bit, and then the resumption has now brought that indicator up to 0.67. That's an extraordinarily high reading. Anything above 0.4 really has been remarkable. So really the last 10 days from this point onward, the fact that this continued to gain at such an extended rate is really remarkable. This would have been the logical break point for a pullback to be consistent with the previous pullback. So this has just been a trader's nirvana. The overbought is now almost 20 days and has dominated the last 5 months. The jaws of PPO have continued to give us signals when this upward move was being reinforced rather than pulling back, and it's still open to the upside, and all systems go. ETF2, everything is above its 4-month moving average, so it's still 100% invested, 0% cash in the allocation model. The S&P at 48 is better than the globals at 42, and inside the U.S. it's technology, then large caps, then mid caps, then small caps, the two strongest sectors, Latin America and U.S. tech, and the two weakest sectors, U.S. small caps and Asia less Japan. Inside the sector spiders, consumer discretionary, healthcare has now recovered. Utilities have begun their rebound, but they really got smacked with an over 10% loss across the sector here lately, and I believe it's yield hunters now starting to come in to buy yield on sale. Inside the market health check, the Dow, but then the underperformance in the small caps, and then generally pretty good in technology across the board. China, Brazil dominating, Canada, Mexico underperforming. Treasuries, bonds, and real estate just getting smashed, and that reflects the outperformance of oil, but there's some signs of that topping this week. The ETF2 lens, I look for green and white as signs, or even green and yellow as signs of emerging strength. So biotech in Brazil, really remarkable turnarounds along with China. White and green are areas in which they had been previously excellent and are starting to lose a little bit of steam. So caution there among financials, spiders, semis, and IT. Daily liquidity stats based on average daily dollar volume of the last 30 days, and then the relative volatility, red exceptionally unvolatile, green exceptionally volatile. These are become very good traders because they are both intraday volatile and very liquid. So that's why Brazil is always on our list. Shifting to the daily, No signals in channeling and overreaction among the big indexes. XIV firing on 551W, 5DD, and channeling. Apple, both channeling and overreaction. 551Ws in Chevron and Caterpillar, and then only 4 symbols testing out well on the auto framer. Hard for that to get a lot of signals. If the market keeps going straight up, that means that there's not a lot of wiggle room between the current price and the 10-day high. In the Dow, however, there are some standouts. GE has been getting smashed in all of the time frames and is at almost 9-to-1 on a reward to risk ratio. And I'll be working through that one with the advanced swing trade course people to take a look at the particular strategy for GE and for Apple, Procter & Gamble, and AXP. Intel, you can see, we saw before, it was just amazing, big one-day move. So let's go see if we'll examine that one pretty close, see if we trade that one intraday as well. Procter & Gamble also of interest on a RSI2 number of just 2 of 8. So that's like a 2-day washout, if you will. So we'll be looking at Procter & Gamble. Daily pinch and stretch. Pfizer and XIV are both in super pinch conditions. So this one is very interesting on the volatility. That is sort of an indication that the volatility trade has been going sideways while the market has been going up. And so it's either going to pop and then take over the leadership once more, the inverse volatility, or we're going to see that long, strong bull get undermined a little bit and have a pullback, which would trigger volatility, which would make XIV suffer, which would make VXX an excellent one. So we'll take a look at trade framing that one with the swing trade workshop. Some auto framers, again, that test out better than 2-to-1 on a retest of the 10-day high. The usual suspects, GE, Procter & Gamble, American Express, and IBM. The regression line fractal framework. These are the symbols in the top shelf that are the most ATRs, average true ranges, below their own long-term fair value. So that's why it's not surprising to see the same symbols in there, like GE, Procter & Gamble, both almost 3 ATRs below long-term fair value. And then in the red, these are the ones that have been relative strength winners and are the most beyond their long-term fair value. So they've been pulling away. And this is how many ATRs beyond fair value they are. And that's an indication of just how strong those moves have been. 30-period regression line, the polynomial one has crossed over the straight line, and that's usually a sign of acceleration. And you can see now that it's almost 4 SDs above its long-term slope. That's just how extraordinary these last 30 days have been. Here you can see that in the longer context of the last 180 days. When you get these crossovers, either to the downside or to the upside, and a very important turning point. So when it refused to come back to the long-term fair value and resume, that was an indication that something unusual is going on. It gets that kind of a move. This is now, based on the last 10 years, this last 30 days of SlopeStat is among the top 4 ever in the last, not ever, in the last 10 years, I should say. After each one of those, there was a pullback, at least to the average, and then all the way down to 1 SD. So this one did it. This one did it, came all the way down. This one did. This one hasn't started yet, so that would not be unusual. This is a zoom in of the last 200 days. This is 10 years, that's 200 days. All 3 of the slopes of the regression lines are well outside of their Z-score river here. That's unusual. Again, very unusual behavior. And now if you just look at the last 180 days, how this has been a grinding bull, this has been the surprising Trump Teflon bull at the start of the year. I just think that is New Year money coming in and buying all the relative strength leaders and it's a January effect. So I'm enjoying the ride, but I am measuring my stops all the more carefully every day. And that's everything I want to cover from this weekend report. We'll go into much greater detail for the advanced swing trade trade frames and portfolio review. That has been a remarkable ride for people that have been with us since the 1st of January, that have been able to take advantage of the swing trades that we've been working through every day in the chat room and in the daily debriefs. A lot of good work being done there. Not too late to join. We're recording everything as a home study course, and if you find swing trading to be of interest, please just get a hold of me and we'll see what we can do. Take good care, keep your wrist measured and your powder dry.